Welcome students. So in the previous class we were talking about the written credit policy, that there should not be any liberty given to the marketing staff or to the sales people to extend any amount of the credit period, as well as the any other kind of the decision making that should not be left to the marketing people or to the sales people, because their objective is only to maximize the sales or to achieve the targets, and not to bother about that whether the sales are on cash or on the credit, and even on the credit then what will be the position of collection of the credit sales. There can be the possibility that we are selling more on the credit, so we will have to face a problem of the more bad debts. So as I was discussing with you in the previous class, that people or experts in the area, many academicians also, researchers also have emphasized upon that every firm should have the written credit policy, so that no marketing or the staff people are given any laxity to decide the credit period or the trade discount or anything else. So if it is the written component, then that becomes very clear to all, and becomes objective also, and the content of the subjectivity goes down, and that is much more in the interest of the firm, because maximizing the sales is an important objective, but selling more on the cash or maybe on a acceptable credit terms is more important for any firm to think about, that their credit sales are collected on time, collected in full, and the magnitude of the bad debt or the bad debt losses is very less, right. So I was talking to you in the previous class as well, that the firm should do something like working out a score, that we can have the credit rating of the different buyers, or we can score them, or we can assess their borrowing capacity as well as buying on the credit, and if they attain a certain score, then it is fine, we can extend the credit. But if any buyer or any channel of distribution is not attaining that score, then I think they should be denied the credit. So how to work out that score and how to have a objective and the written credit policy, that is a $1 million question, and we will learn about that how to develop some framework, some system that every marketing and the sales guy has to follow that and take the decisions in the broader perspective as well as in the larger interest of the firm. So let us see mechanism or the framework which is worked out and which is suggested to us by an academician, a researcher called as Smith. Professor Smith has worked out a mechanism, very simple, not very complex, very simple, and on the basis of that we can work out the score of the different buyers. Maybe he is a channel, he is a distributor, wholesaler or retailer, or maybe the final buyer. He has to attain certain score, and if it is not possible, then that scoring can be taken as sacrosanct, and the person or the borrowing entity may be denied the credit. You might have been seeing in these days also the banks in India, they also work out some score, that when we go to seek the credit, maybe for constructing a house, buying a car, or maybe any other kind of the loan we want to take from the bank, they calculate the score, that is a credit score for every potential borrower. And if that potential borrower is attaining that much score calculated by the banks on the some given or some pre-specified methodology, then it is fine. Otherwise it is not possible to extend the credit to all kind of the borrowers, because credit scoring is important mechanism, and we should rely upon that, and everyone who is involved in granting the credit, sanctioning the credit, must follow the instructions as well as must follow the tradition of working out the score for every borrower, so that the investment made by the firm in the credit sales is safe. So let us see that how in the business terms, or in case selling the goods in the market on the credit and extending credit to the different buyers on credit, how this score can be worked out. Let us learn about the mechanism about that. So it is very simple, as I told you, Professor Smith has worked it out and suggested to calculate a score. So let us assume some particulars here, some parameters here, and first we talk about is that some firm want to sell something in the market on credit. So their sales amount is we take it as very simple amount, say rupees 100. They want to sell for 100 rupees in the market on credit, and return on sales, ROS, is expected to be 10%, right. that is 10%, that ROS, return on the sales, is expected to be 10%, and additional collection cost in the event of default or maybe in case of the delayed payment. Sometimes what happens that the collection terms as well as the time period given, credit period given, remains pre-specified, but sometimes some borrowers or maybe some customers on the due date not make the payment. So firm has to make some extra efforts, and it involves some costs, issuing the notices or maybe some sending the letters, calling them. So people have to work on that. So there is a cost. So additional collection cost is, say we assume here in this case, is rupees 1, right. Now with these three things in mind, sales of 100 rupees, return on sales is 10%, additional collection cost is rupees 1. If these three things, the particulars are there with us, then how to calculate the credit score of the different buyers on the credit. So we will have to develop a framework, and this can be developed like this. Say we will write here something like that: alternative outcomes of a credit decision. Alternative outcomes of a credit decision, that if you want to alternative outcomes of a credit decision, that if you want to give the credit, then how that should be decided. So we will have, say for example, we have here the particulars, we put here as the particulars, and here we have three say outcomes. We can say that there can be possible three outcomes. First outcome is customer pays promptly on the due date. Customer pays when it comes the due date, customer pays promptly. There can be another, say possibility, customer delays payment, and third can be customer never pays. These can be three things, three outcomes: customer pays promptly, customer delays payment, customer never pays, right. These can be three things. Now under these three circumstances or three situations, let us work out whether to grant the credit or not to grant the credit. First we say start with, say let us assume firm takes a decision to grant the credit, So it is grant credit means what will happen? First we write here as the amount. This is the amount, and amount here is customer pays promptly. So what will happen? If we are going to take the decision of granting the credit, what will happen? Sales and profitability increased. This is one. Second can be increased collection expense, because when he will delay the say payment, so certainly we will have to write to him, make him phone calls, or maybe sometime issue the notices. So we have to go for the increased collection expense, or collection cost will increase. And then if he never pays, then what will happen? We will first try. So what will happen? Increased collection expense plus bad debts. So in that situation this will happen. In the first case, if the customer pays promptly, we sell him, grant him credit, on the due date he makes the payment. So sales and profitability both increased. In the second case, customer delays payment. In case the customer delays the payment, so what will happen? The firm has to make some extra efforts to receive the payment. So that will be causing the increased collection expense. And in the third case, customer never pays. So what will happen? Increased collection expense plus bad debt losses. So bad debt losses will increase. So in this case, first we start with something like, say we will see here that first thing is that the amount. So we will start with the amount, and amount here is, that is how much amount we are selling for 100 rupees to him. Sales and profitability increase, our return on the sales is 10%. So it means what will happen if we customer pays promptly, so sales increase, 100 rupees we sold to him on credit, and profitability increase by how much amount? 10 rupees, right? But if he say delays the payment, so what is the additional collection cost? That is 1 rupee. So what will happen here, that customer delays the payment, so increase collection expense. So what will happen because of the increased collection expense, that 10 will be reduced, minus 1 is equal to 9. We will not receive 10 rupees as the profit, but the profit will be reduced by 1 rupee because we have to send him notices, make phone calls, so we have to spend time, energy, everything. So that 1 rupee will be lost in the increased collection expense. So the firm will finally receive out of 10 only 9 rupees. And for example, in customer never pays, he defaults, he says that, oh, I'll not pay it, and maybe because of any reason firm is not able to collect that credit sales. So what will happen, that will be totally a bad debt for the firm. So but the firm will not lose that bad debt just without even trying. Firm will lose only after trying sufficiently. They will send him notice, they will convince him, they will make him phone calls, they will write to him everything. But even after doing everything, if it is not possible to recover the sales from him, so in that case what the firm has lost? Firm, first thing is firm lost the profit, means no profit has come to the firm, that 10 rupees are gone, and out of that 100 rupees sales, 90 rupees is the cost, that cost is also not recovered, right. So first firm's direct loss is the cost, and that cost is, say for example 90, so 90 rupees loss is there, and in this case say for example the total loss is how much? First is, that is 1 rupee which they spent as a collection cost, plus 90 rupees the cost which they had incurred to manufacture that product, that is also lost. So finally the total loss is how much? Minus 91, that is 90 rupees is the cost of production and 1 rupee is the collection cost, so that 90 rupees is lost in the market. Now what is the probability of these three situations, this and this situation? Let us assign the probability now. Probability is probability of happening this is only assumed probability on the basis of the experience of the firm, and for example here the probability is 60%, here the probability of happening this situation is just 35%, and here the probability of happening this is just only 5%. So this is the 100%, this makes the 100% probability. So what is the weighted value? If you calculate the weighted value in this case will be how much? You can calculate the weighted value, here it will be 6, here it will be how much? That is 3.15, and in this case the weighted value will be how much? minus 4.55. This is the outcome of the first case, that if the firm takes a decision to grant the credit, there can be three possibilities: customer promptly pays, customer delays the payment but pays later on, and customer never pays. So if the customer makes the prompt payment, so firm is earning 10 rupees profit, probability of that is 60%, so the weighted value is 6. If he delays the payment but makes a payment after say the delay, but the firm has to shell out 1 rupee as a collection cost, so it means firm will get only 9 rupees as the profit, 1 rupee profit is lost in the expense, so the weighted value of that will be 3.15. And in the third case, if he does not pay entire amount, cost plus increased collection expenses will become the bad debt, and that will be the increased collection expense plus bad debt losses, that will become, that is the weighted value of that is 91, and weighted value of that becomes, assigning the probability which is only 5%, but 5% is there, that is minus 4.55. Second situation can be reject credit. The firm can say that no, we will not give the credit to this person or this firm. So in that case what will happen? They may take a decision, that is of reject credit. So if they reject the credit, what will happen now? Again we will have to take the three things, and the first thing here is, that is the amount, second here is the probability, and third here is the weighted value, right. So in this case the outcome will be what? Reject decision will be that lost sales and profitability and profitability. In the second case, lost sales and profitability, lost sales and profitability minus say collection expense, minus collection expense, at least we saved the collection expense. And the third case can be, that is the collection expense and bad debt losses avoided. We saved everything. If we are rejecting the credit, what will happen? We lost 10 rupees. We did not make him the sales, so we lost 10 rupees. In the second case, we rejected the credit. The second option can be, second outcome can be lost sales, we lost 10 rupees, but we did not lose 10 rupees, we lost 10 minus 1 rupee, otherwise that was not going to come to us, as we have seen in the first case, that is 9. And in the third case, that if we are not granting him the credit and the probability was that he will not make the payment, so in that case we have saved the total, that is 91 rupees we have saved here. So what is the amount we are talking about here is, that is minus 10, the amount is 10. Second is here, that is minus 10 minus 1, that is say finally it is equal to minus 9, and in the third case it is 1 plus 90 is equal to 91, that the amount which we have saved is, that is 1. So you see the sign here is minus 91 and it is 91. We lost 91 here, that is why it is minus 91, we saved 91 here, so that is a plus 91. Again we assign the same probability here, so the probability here is again 60%, probability here is, that is 35%, and probability here is, that is just 0.05, only 5%. So what is the weighted value? If you calculate the weighted value here, this will work out as how much? That is minus 6, this will work out as minus 3.15, and here it will work out as 4.5, right. So these are the scores finally with us, again as it was earlier, these scores are again available with us, and here the scores are same, only the signs are changing. In this case it is plus 6, it is minus 6. Because we earned profit here, we lost profit here when we are not rejecting the credit, when we are not granting the credit. In this case here the weighted value is, that is plus 3.15, that is a weighted value because we earned only 9 rupees, not 10 rupees, but here we have the weighted value is minus 3.5, that we did not lose 10 rupees. In this case we would have lost 9 rupees, and in this situation we saved 91 rupees, so the weighted value of this is, so here the sign is positive, it is negative, it is positive, it is negative. If you see the sign here, it is negative, which we had lost, means we would have lost in case of granting the credit, but if it turns out as a bad debt. But in the another case we have saved the total 91 rupees, that is the cost of 90 plus collection cost of 1, everything is saved. Maybe the probability is 5%, so if you look at this, this is 4.55, and in this case the finally the value is 4.55, earlier it was minus 4.55. Now I would ask you to calculate the final, say you sum it up all three, this plus this plus this, how much is the value? You again sum it up, this plus this plus this, how much is the value? If you sum it up, final score will work out as, final score or final, irrespective of the signs, the final score will work out as, that is 4.6. This is the final score, this score is 4.6. So it means after say evaluating the whole thing here, we have found out here is that we have used a mechanism with the help of which we can find out a score, and the score which we have worked out here on the basis of the framework provided to us by Professor Smith, that has been worked out as 4.6, and this way the score for every borrower or the potential borrower can be worked out. We can think about that what could be, if we say grant him the credit, if we not grant him the credit, what is going to be the final score, and that score will remain the same depending upon the probabilities. So here in this framework the $1 million question is that assigning of the probabilities. We know that what is the amount of sales we are going to make, clear. We know what is our return on sales, that is 10% in this case, and otherwise in the practical life we know that how much is the return on sales, and we also know that what is our collection cost. Only thing is which we do not know and which we have to be very careful looking at the past behavior, or maybe if the buyer is totally new, if the firm has no relationship with the buyer or the potential buyer in the past, then we can inquire data about his performance or his overall financial position or his behavior with other suppliers or other firms in the market. On the basis of that we have to assign the probabilities. So, assigning the probability is a $1 million question here, most complex task here. It may be possible that the customer was good, but we assigned him very high probability of not making the payment. It may be possible that customer was bad, but we assigned him lesser probability of not making the payment or defaulting in making the payment. So, anything may go any outcome may be there. So, we will have to be careful that what probability has to be assigned. Another important question here is we have assigned only 3 probabilities because we have taken the 3 cases. So, there can be more cases also. Say for example, we are saying here customer pays promptly, customer delays payment, customer never pays, right. These can be 3 situations which have been broadly thought of, but there can be in between situations also which have to be practically seen, and if not in between situations only 3 are there, then the probability is a very important thing, that how much probability we have to assign. In this case we are saying in the first case is 60%, which is larger. Then second probability, which customer delays the payment and we have to spend extra on collection costs, that is only 35%. In the third case we have assigned the probability only 5%, that can be changed also. We can make it 70, maybe 25, or maybe 5, or maybe we can have say any other set of the probabilities. So, working out of the probability will be a very say tedious job, very serious kind of the job, which should be done at the firm level or at the senior level in the firm, so that or maybe there should be a very clear cut mechanism that, for example, look at his financial position. So, we can assign some score, on the basis of that we can think of assigning the probability. Second thing is his behavior with the existing suppliers in the market, you can on the basis of that assign the probability. Third thing is his existing say level of the sales he is making in the market, and say the customers base he has that he is serving in the market. All these factors can be taken into account, and finally we have to work out a score. Maybe we can use these 3 outcomes. So, under these 3 outcomes, in this case for example we have worked out a score which is 4.6, right. In both the cases if you total it up, it works out as 4.6 in the lower part, 4.6 in the upper part. So, it means what this score means. Firm may finally have a written very clear cut credit policy that for every potential buyer on credit we will work out a score, and that score is not permanent. That score has to be revised over a period of time, because credit worthiness of the people or the buyers in the market keeps on changing, right. It may be possible that depending upon the order size, if you are selling for the smaller amount, he does not want to default and he does not want to spoil his name in the market, so he is not defaulting. He is very regular, he is very prompt, and he is very careful in making the payment. But if we increase the order size, looking at his past behavior, if we increase the order size or he increases the order size and firms sells him for the increased amount also, and once he buys at a larger scale, and then if he refuses to make the payment or he start defaulting, then there may be a possibility. So, firm has to have a very clear cut policy that for every customer may be existing, then on the periodic intervals, and if it is a new, then we have to work out a score and credit score, and on the basis of the score we will have to take a decision. So, for example, in this case we have found that the score is 4.6. So, firm may have in nutshell a policy that any customer who has to be granted the credit must have a score of not 4.6 but at least 4.5. If the score of any customer who crosses or who attains this score of the 4.50 or crosses this score will be granted the credit automatically. If this score is less in case of any or in respect of any buyer, we will reject him the credit, because in that case it may be possible that he will default in making the payment. We have to spend a lot in say say in say prompting him to make the payment, or there may be possibility that he never pays. So firm can't do anything beyond a level, it can't be done, so it has to be considered as a bad debt, and finally we have to bear with that losses or that bad debts. So firm can have a written policy that to the marketing force, to the sales people, it remains communicated that you go to the market, you talk to the different channels of distribution or the customers, you calculate a score of every customer, every buyer on the credit, and think that if the score is 4.5 or above, then you grant him the credit, but if the score is less than that, do not grant him the credits. So that will create a say you can say bottleneck, or maybe a benchmark also. I would call it as a benchmark for the sales people also, for the marketing people also, that they cannot take a decision blindly and without considering the credit worthiness as well as the past behavior and the financial position of the customer, and they risk the firm's sales or maybe the collection of the sales. That should not be done. So in that case, finally they have to arrive at, because if the score is working out as 4.5 then or 4.5 or above, then there is no problem. I think they are quite objective in taking the decisions, and he can defend himself. Even despite that, there can be the possibility of the bad debts or the losses, but at least sales and the say marketing people can defend themselves that we have calculated the score, this was the probability of making the payment, this was the basis of assigning the probability to these three different outcomes, and finally we could make out that the score is say certainly above 4.5. So even after that he is defaulting, then it is a different issue that can be taken care of, but if the score is less than 4.5, then it should not be allowed. In the banks also we are doing like this, that when we go to the banks and like to borrow the money from the banks, they always calculate a score. Age of the borrower is a very important criteria, monthly repaying capacity of the borrower is a very important criteria, his income, total income is also very important criteria, number of dependents on him is a very important criteria. On the basis of all these different criteria, they assign some points and then they total it up. If the borrower attains that minimum score decided by the bank on the basis of the risk profile of the borrower or the potential borrower, then only the credit is granted. Otherwise, bank asks the borrower that you improve your score. If he improves the score, then fine, he is a good customer. If he does not improve the score, then he is not a good customer. So here every company, while selling their production in the market on credit, because it is a very hard efforts of the companies to manufacture and then to sell the product in the market. Selling on the credit is not bad, but it has to be a secured credit, since we are selling in the market without collateral. We are not taking any security. If you are taking advance checks from the buyer, then there is no problem, or maybe there is any other collateral we are taking, then there is no problem, but without any collateral, without any security, without any advance checks received from the buyers or the channels of distribution, if this thing happens, then this will create a problem. Many times what happens, the companies who do not have the good rating of their products in the market, whose products are not normally liked by the customers, pushing those kind of the products in the market, companies take the risk. Say for example, you want to buy a color TV. Normally if you want to buy a color TV, we go to the market and think of that either I will buy Samsung, Sony or LG, this kind of the products. But in the market, if you go in any electronics store, you will find Videocon is also there, and Oneida is also there, which enjoy lesser say preference from the customers or the lesser rating in the market these days. Earlier they were the leaders in the market, but now because of the changed economic scenario, their say preference has gone down. So people sometimes don't want to buy these products. So even these products are there in the market. So what happens, these companies, to push up their sales, they give the unlimited credit, unlimited period of time as a credit period to the distributors or to the owners of the stores, that you keep this product on the shelf and in the store, we are supplying it to you on credit. If you are able to sell it off in the market, then you say return our part to us and then you retain your part. Otherwise either we will collect the product back from you or wait for the sales in the market. So in that case, if that kind of situation happens, company is taking a say unprecedented or uncalculated or the unlimited risk, because otherwise also company knows that this product, if it is not passed on to the market on credit, this has to be kept into the warehouse. So this will create the situation of the mounting inventories, and inventory itself has a cost. So because of that reason, they pass on their inventory to the channel of distribution in the anticipation of the sales in the market. So, if that is the situation, then it is a different ball game, then the firms take any kind of the risk and then the scoring does not matter. But in the normal cases, if the product is good, it is acceptable, it is saleable in the market, in that case we will have to be careful in deciding to whom to give the credit, how much credit, what should be the order size and what should be the credit period. So, all these credit terms have to be carefully decided, so that credit sales made in the market, 100% of the credit sales amount is collected, it comes back to us and nothing is caught in the market. So, this is the way how to calculate the score and how to take the objective decision, and the firms can have a written credit policy. Now, we will talk about certain other things also, that is say credit limit, how to decide the credit limit. For deciding the credit limit, we have the two different ways, that is information credit limit and the risk credit limit. So, what are these credit limits and how these credit limits can be decided, that these are the two other important things also as far as the collection of the receivables is concerned. We will discuss these things also, we will learn about deciding the credit limit also, but that too in the next class. Thank you very much.